थोड़ा सा डिले होता है ना 3 से। बोलो कुछ।
Hello everyone, can you hear us? Hello everyone, can you hear us? I guess we can start now. If you can confirm me over the chat if the video and the visual both are clear. I guess we can start now. If you can confirm me over the chat view and Hi Sukhinder. Sukhwinder, can you hear me? Hi Neha, can you hear me? I guess I'll start. We are expecting a few others to join as well, but it's time, so I'll start with the session. First of all, welcome, and thank you for taking out time for the session. I'll give you a brief introduction. My name is Anupam Rungta. I own this company called Feliz Consultancy. We are into portfolio management services. And today's session is regarding investor awareness program, wherein we will discuss all the asset classes, including PPF, FD, real estate, gold, insurance, stock market, mutual fund, tax saving schemes, personal finance. We'll discuss briefly about Indian economy as well. So the idea is to give you a gist of all the available asset classes, to give you a gist of the pros and cons of investing in these assets. And the agenda of the session is that by the end of the program, you should be able to take an informed decision on your investments in whichever asset you want to. So I'll start with the presentation. So broadly, if you look at the asset classes, these are the 5 asset classes we have our money divided into. We invest in real estate. There is fixed income, where you have fixed deposit, recurring deposit, post office, PPF, etc. Then there is equity, that is share market, and even startups comes into this category. Then we have insurance, and then we have cash in hand, including gold. Broadly, these asset classes represent this. I mean, it's pretty simple, so I would just skip this part. We'll look at some comparison on the basis of some characteristics of these asset classes. So I'm looking at stock market, real estate, gold, fixed deposit, and PPF. Now, if you look at the first characteristics, you talk about investment required. In stocks and mutual fund, you can invest as low as the price of the stock, and in mutual funds, you can invest as low as 500 rupees. In real estate, we all know the capital intensive asset. Gold is medium. Fixed deposit and PPF, again, the investment ticket size can be very low. I just want to confirm that you all can see the different slides. We are on slide number 4 right now. So next we look at liquidity. Stock market's very high. You can liquidate your investment within 2 days. Real estate, we all know it's very low. No matter how good the property location is, the kind of time it takes to liquidate is usually very high. Gold, it is again very high. You can liquidate your gold investment at any point of time. Fixed deposit is very high. It takes 1 or 2 days. PPF, it's low. It's a 15-year lock-in, and you can start withdrawing from 7th year in parts. The best part is tax on returns. So in stock market, not many people are aware, less than 1 year of investment, the tax is 15.45%. After 1 year, the investment becomes tax free. So if you're investing 1 lakh in stock market today, and after 13 months, if you exit and the profit is 20,000 rupees, that entire 20,000 goes to you without any taxes to the government. Real estate, first 3 years, you have to pay as per your income tax slab. And after 3 years, it is 20.6% post indexation. So indexation basically increases the cost price as per the inflation. So your profits are reduced to that extent, and the tax payable is also less. But it is never tax free in real estate. Gold, again, same as real estate, fixed deposit as per your income tax slab, and PPF, it is nil. Now PPF, one thing I would like to mention here, every year the government of India declares the interest rate. So it is 8.1% now. It was 8.7, 8.8% for a very long time. So across all the investments, the interest rates have been reduced by the government in the recent past. So that's why it comes down to 8.1. Coming to the next characteristics, sell in parts. So what it means is, say I have a plot of worth 50 lakh rupees and I have stocks of worth 50 lakh rupees, and I need 20 lakh rupees for my need. In stocks, I can sell 20 lakh rupees, and the remaining 30 lakhs will be kept as invested. In plots, in real estate, that is not available. So I have to sell the entire plot or entire flat. I cannot sell in parts. Gold, again, yes, you can sell in parts. Fixed deposit, you have to break the entire FD. You cannot break FD in parts. PPF, again, as I said, you can start withdrawing from 7th year onwards in parts. So terms and conditions apply there. Coming to risk, stock markets, definitely the risk and volatility is high. Real estate and gold, it is considered medium. Fixed deposit and PPF, it's risk-free, technically and theoretically. So that's about the characteristics. This circle which I have marked, the red circle, the message we are trying to give here is that in Indian households, more than 90% of investment is in real estate, gold, and fixed deposit. That's how the generations have been saving. Invest, and very small amount is invested in PPF, and stocks is almost negligible in the Indian society. So PPF and fixed deposits are pretty simple, risk-free investments. Nothing much to talk about it, to be very frank. Real estate, I believe it's a national favorite topic, and everyone is an expert in real estate. There is not much to delve into detail. So let's talk about stock market, gold, insurance, and other topics, including personal finance, in the next few slides. Coming to gold. So maybe you guys can keep writing your questions if you have any. I'm looking at the chat and I can answer your queries in between. Coming to gold, let's take from 1980, the return in golds from 1980. Why I'm saying 1980? If you guys are aware of this index called Sensex was established in 1979-80. So we will be able to make an apple-to-apple comparison. So if you look at gold investment, say your parents or your grandparents invested in gold in 1980, and they have kept that gold till date for more than 35 years now. What do you think are the returns generated by gold in these 35 years, compounded annually? Now I give you a context to this. If you invested in fixed deposit, which is risk-free investment in 1980, and you renewed your FD every 5 years, you would have made 9.5% till date. So that's a risk-free investment giving you 9.5%, right? So now gold, there is no guarantee, of course, so risk is higher. So you will definitely expect more returns in gold compared to fixed deposit. So having said that, in the international market, gold is traded in dollars, in dollar terms, and then it is converted to rupees in India. So you might be surprised to know that in last 35 years, in dollar terms, the returns have been 1.71% only. That is less than your saving bank account. But at the same time, in last 35 years, rupee was depreciating compared to gold. So because of which the returns in rupees were higher compared to this, and it was 8.33% compounded annually, which is less than your fixed deposit returns. So gold has not been a good investment asset class for last 35 years. Even though the perception is different, usually people are play speculative trading on gold, and they do make money, they do lose money. So on an average, the returns have not been good. Having said that, just think about it. In last 35 years, dollar went from 20 rupees per dollar to 70 rupees per dollar. So 3.5 times. To maintain the same returns, rupee has to depreciate by 3.5 times in next 35 years, which is unlikely because the gap between US and India will decrease in terms of developed economy, and we expect rupee to appreciate over a long period of time. Short term, 1 year, 2 year, 5 year, it might depreciate more, but a long period of time, it is expected to appreciate. So actual returns in gold were 1.71%. Because of depreciation, it became 8.33. Depreciates or does not depreciate this much, the returns will be even worse. So gold has been one of the worst investments in last 35 years, and it's expected to be even worse going forward. So that's about gold. Rohit, regarding the text part, we will come again. We have stock specific slides in the after next few slides. So I'll take up that again. Coming to insurance. Now insurance, as per our observation, has been the most it's a product which is missold the most. The misguiding in insurance has been rampant in India. Till 2001, we had only LIC as the insurance player, 2001, after which the reforms took place and private players entered. Looking at insurance policies, broadly, life insurance is divided into three parts, three kinds of policies. We have traditional plan, we have ULIPs, and we have term plan. Now, if you look at the characteristics of traditional and ULIP plan, they are more or less the same. The only difference is in the third row. In traditional plan, your investment goes into debt schemes, and in ULIP, it goes into a mixture of debt and equity. So I'll just explain you briefly. Traditional plan, if you are 30 years old and you take a policy for 30 years of say 20 lakh rupees, and you pay certain premium on that every year, make some payment. If something happens to the insured person, the nominee gets that 20 lakh rupees. If nothing happens for 30 years, you still get those 20 lakh rupees. So that's why it's called death and maturity benefit both. Something happens to you, you get the money. Nothing happens to you, you still get the money. Second characteristics, the premiums are high usually. Third, it is invested in debt scheme. Returns is between only 4 to 6% in case of traditional plan. ULIPs, it is a bit higher because of the equity part involved. Coming to term plan, it's only death benefit. So it's like an insurance of your vehicle. Something happens to your vehicle, you get the money from the insurance company. Nothing happens, you just end up spending that insurance premium. Happens with the term plan. If the insured person dies, the nominee gets the money. If nothing happens to him or her for next 30, 35, 40 years, whatever the term of the policy is, there is no repayment. Having said that, the premiums are very low. It's a pure insurance, so there is no return, and tax deduction is there. So tax deduction, as in the tax exemption of 1.5 lakh rupees, which you get every year, that is available in all the three kinds of policies. Tax on claim amount. Now, there's in case when the claim comes up, or in case of even maturity, it depends on the traditional and ULIP policy whether it will be taxed or not. There are different kinds of policies, but in case of term plan, in all the term plans, it is nil. So there is no tax to be paid. Now, to explain it mathematically, say there are two people. One person takes a term plan and another takes a ULIP plan. Both the plans are for policy cover of 1 crore rupees. The of the investor is 30 years and the policy term is again 30 years. So the person is covered till the age of 60 years. So you'll be surprised to see the gap in the premium amount. In case of term plan, it is only 12,250 rupees. In case of ULIP, it is 9,80,000 rupees. So it's a huge difference. Now, what this person does is, the person who is taken a term plan, the money which he is saving, he invests that money in stock market divided by 12. So every month he invests 80,000 rupees in the stock market. Now in both the cases, total investments turns out to be almost 3 crore rupees. But at the end of 30 years, in case of term plan plus stock market, the expected return is 28.5 crore in case you get 12% returns in stock market. We will come to this part, why 12% I have taken. We'll come to that later. And in case of ULIP plan, in the best case scenario, it is 10 crore rupees. So you can look at the difference. Now, usually the insurance agent will not sell you term plan because it is very easy to convince you as an investor to take a ULIP or a traditional plan. Because I will say the agent will come and tell you that why do you want to go for a plan which does not give you any return? I'll get you a scheme which gives you insurance as well as return, which sounds very convincing. Now the trouble with this is that you don't question back and say that what is the premium of term plan. You don't compare that. If you do, you will realize why would you not take ULIP and why take term plan. So usually the mindset of getting something on maturity is the reason of the mis-selling which is happening. And the agent will never convince you for term plan, because the brokerage calculation for the agent is not on the policy cover. It is on the premium which he gets for the company. So if he's getting only 12,000 rupees for the company will give him brokerage depending on that 12,000 rupees. If he's getting 9,80,000 rupees to the company will give him a much higher brokerage. So why would he sell you a term plan? As simple as that. This is just a brief about how much insurance you need. You can take some cue from this. So look at the second column. Say your monthly expenditure is 50,000 rupees. So the idea of insurance is something happens to you, your wife or whoever is a nominee who is dependent on you gets that money. He or she would put that money in FD, fixed deposit, and some interest will be recovered from that fixed deposit post tax. That interest should be enough to maintain the same living standard which he or she is maintaining when you are there. So given that, say your monthly expenditure is 50,000 rupees and you want that after you are, in case something happens to you and this money comes to your nominee, that money should last for 8 years. Look at the third row, sorry. So in that case, you should take a 50 lakh policy. But if you want that money to last for 16 years, take a 1 crore policy or maybe higher. Now, you just looked at the premium amount of term policies, which is very low. So usually people do cover 1 crore and more of insurance depending on their expenditure and also on their income. So if you talk about personal financial planning, the first step is term insurance. Extremely important. The second step is health insurance. Again, the premiums are very low. There is no return, of course. Something happens to you, you are hospitalized, you get the money, otherwise you don't. But the premiums are very low. And the third part is investments. If you look at any individual, it's most of the cases it's in the reverse order. So for everyone has invested in some or the other place. Very few have got health insurance and negligible number of people have got term insurance. Whereas it has to be the other way around. So in case you have been a victim of mis-selling and you have bought any of these money back, endowment, your ULIP plans or traditional plans, you should just find out the policy for surrender. And if you get a decent amount back, you should just close that policy. That's what our advice is, because the kind of returns is very bad and the kind of cover you're getting is not appropriate. You need a 1 crore policy and you have a 10 lakh policy or 20 lakh policy. So that money would not be enough anyway in case of a mishappening. So insurance is not supposed to be an investment. It is an expense. The generation which was above us, our parents and grandparents, they have always invested in LIC. And it was always an insurance investment product. It was never a term insurance policy. Term insurance was not sold by LIC till 2001. So the only two policies you need is term plan and health insurance. The day you have that, you can put a board outside your house, insurance agents not required, because you are really covered. You are totally covered. You don't need any other policy. Any queries? Then I can move to the next, that is stock market. All right, so I'll move to the next. Should you invest in stock market? Well, to give you an idea, in India, around 2% of the population invests in stock market, which is very low compared to the developed and even to the developing economies. In US, for example, 50 to 60% people invest in stock market. In China and other developing economies, it is 20% plus. So the awareness for stock market and the risk appetite or the knowledge of investing in stock market is quite low in India. So we'll cover a few topics here. Stock market. One name which I guess everyone would know is Warren Buffett. He's the fourth richest person in the world today. 86 years old today, and he's the chairman of this company called Berkshire Hathaway. Now, Berkshire Hathaway does not produce any product. They don't have any service. It's like a holding company. So they buy shares of different companies, 1% stake, 2% stake, 5% stake, even 100% stake. And when these companies make money, Berkshire Hathaway makes money. So you can, Americans and other as well can buy Berkshire Hathaway shares. And as the company makes money, and it's like any other usual share. Now, this guy is the fourth richest in the world today. He has made his entire wealth through stock market investing. The reason he's famous is not only because of being rich, it's also because he's extremely transparent in his sharing about his experience in the stock market. He transparently shares what blunders he has made in the market, what kind of investments he did, what he did right, what he did wrong, what you should look for in a company, what you should avoid. So all these things are transparently shared by him every now and then in interviews, in articles, through books. So that's what makes this guy, famous in this industry. So there are some fundamentals which he has defined while selecting stocks, which I'll be taking next. Before that, Philip Fisher is one of the gurus of Warren Buffett. So as he says that market is usually filled with individuals who know the price of everything but value of nothing. So what he's trying to say is usually that trading mindset in stock market. You get tip from someone that TCS is trading at this price, now buy this, it will go to this in 1 week, and you buy that. So you're just playing on the price. You're not looking at the value of the company, valuation of the company. So that's a trading and a speculative mindset. That's not an investor, right? Again, so short-term market forecast is something which is totally banned in the Warren Buffett's dictionary. He is a long-term investor, and that's what he advises everyone to be. So we looked at that comparison chart in the beginning where we talked about stock market being volatile. Now, that was the only characteristics, the only quality of the stocks which was going against it. Now, as per Warren Buffett, volatility is a long-term investor's best friend, provided you have knowledge and patience. So if the stock is trading at 100 rupees and you bought at that price and it came down to 80, now if you have done your research and if you are a long-term investor, you will not panic. You might even buy more at that price because it is an attractive, it's a discounted price. But if you don't have knowledge about that company, you've not done your research, and you are a short-term player, you will panic and you will sell in loss. So that's why these two things are the main major ingredients of investing in stock market: knowledge and patience. Coming to the elimination process. So in India, we have more than 5,000 stocks listed in the stock market. Now, if you start doing your research on every stock, you will end up doing only research and you will never be able to invest. So there is something called process of elimination. You filter out some stocks on the basis of some criteria. And once you filter out them, whatever number of stocks are left, you further do your thorough research only on those particular stocks, not on all the 5,000 stocks. And then you further shortlist 5 to 7 or at max 10 stocks, and then you invest in them. So that's the ideology on which Warren Buffett has been working on since last 60, 70 years. So I have just listed a few criteria which on the basis of which we filter out. So ideally, it should be a dividend-paying stock. It should have a long history of revenue and profit growth. Debt should be minimal or zero. Management track record is very important. How long the management has been with the company, what is the attrition rate, what is the kind of bonus and fixed salary they get. Then the fifth criteria, biggest company in the industry, very important. Now what this guy says is, invest in the biggest company in an industry, and the gap between the number 1 and number 2 company should be huge. I'll take some example. For example, telecom. Now Aircel, Airtel, Vodafone, Reliance Jio coming in. It's a neck-to-neck competition. There is no clear winner, right? I mean, clear winner in the sense in terms of sales as well, and also at the same time in the perception of a layman. So it is debatable which is number one, which is the best company. So we will stay away from that entire sector. We will not invest in that sector. IT industry. Infosys, Wipro, TCS, Tech Mahindra, Accenture, again neck-to-neck competition. TCS is definitely now much bigger than Infosys, but it was not predictable, say 10 years, 15 years back. So again, highly unpredictable industries and no clear winner. Another example, organized jewelry market. Now Tanishq is a clear winner. I'm talking about only organized players, not the local jewelers. So after Tanishq, you have TBZ, you have PC Jewelers, you have Kalyan Jewelers, but there's a clear distinction between the companies. So Tanishq is a brand which is identified by a layman, and the sales. If you look at the sales of the company, again, it's better. It's much higher. So next, coming to the next criteria, banned industry. So IT, pharma, and commodity. These three are banned industries in the dictionary of Warren Buffett. So there's logic to it. Now, if you do some research on Indian stocks, you will find that IT and pharma have given phenomenal returns in the last 15-20 years. So it's kind of irony that we are banning these industries. Now, why we are doing so? Just because an industry is doing good, it does not mean that you should invest in those stocks, because it is highly speculative. I'll give you an example. Few years back, when WhatsApp came in, it has almost shut this company called BlackBerry. Now, the BlackBerry was doing good because of that BlackBerry Messenger feature, free messaging across the world, only BlackBerry to BlackBerry. WhatsApp came in, it said free for all. BlackBerry almost gone, almost shut. Look at Nokia. 10 years back, we had all Nokia phones around. Today, I mean, it's almost extinct. It does not exist. Look at Apple. Apple is twice the size of Microsoft today. No one could have predicted that 15 years back. And they are doing this because of iPhones. It's a computer company, it's a software company, but they're doing this because of iPhones. So IT industry is very speculative. You don't know which player will do what, which R&D department will do better, which will not. So it is not predictable. There are no fundamentals to it. Same is with pharma. So there is research in drugs when it comes to pharma that goes through a licensing process to have FDA. If the product comes in the market, the company shares goes up. If a competitor comes up with a better drug at a lower price, again, the first company shares come down. So again, I cannot predict which company's R&D department will do well. I can't predict that. That's very speculative. Same is with the commodities. Oil. Now, oil came down from $126 to $26-30. Again, it is up to 40-50. So very speculative. So anything to do with these three industries, we should keep away. Companies will not give returns. This filtering which we are doing does not mean that the companies which we are filtering out will not give returns. The idea is to reduce the risk, to minimize the risk and get the best possible returns. So coming to the next criteria, investment by foreign institutional investors. Now, when you read newspapers, any Financial Daily or even the business section of Times of India, usually there is a negative connotation to FIIs. The kind of news which comes is FIIs sold stocks worth 5,000 crores and stock market Sensex down by 2,000 points. So that's the kind of news which comes in. So now there are two kinds of FIIs in the market. One are hedge funds, which are very short-term players. And the other are pension funds of foreign countries or sovereign wealth fund, government funds of other countries. Now these funds, these FIIs are very long-term players. They invest for 10, 15, 20 years, number one. Number two, their research is very strong. So if they are investing their public pension fund in any company in India, we must watch that company, what exactly this company is doing. So that's one of the criteria. The second last, minimum government intervention. Now this is not Warren Buffett criteria. This is something which we have added. He is sitting in US, there's US government, we are sitting in India. There's a lot of difference in the efficiencies of the government. So anything to do with government intervention in terms of PSUs, we stay away. In terms of coal, power, all these sectors where there's a lot of licensing issues, we stay away. Anything to do with subsidy, we stay away. So any company which is getting subsidy on their product, we stay away from it, because the subsidy amount comes at a delayed, very delayed. So the company loses money in interest. The last criteria, we invest in the small and the mid-sized companies, not the large caps and not the blue chip companies. Why so? You take example of real estate. Whichever area, whichever city you stay in, take the most posh area of that city. Say the rates are 2 lakh rupees per square yard of the land. It will take a lot of time to make it 4 lakh rupees per square yard, to make it double. But then at the same time, if you take up some property in the outskirts where the development is happening, the area is coming up, and it is worth 20,000 rupees per square yard, it will not take that much time to make it 40,000 rupees. Potential in small and mid cap companies, provided they are fulfilling the criteria as mentioned above. Right. So if you can maybe write on the chat, just take a wild guess. Out of 5,000 companies I am talking about, in a country like India, where we have a population of almost 130 CR, how many companies do you think are fulfilling all of these criteria? Any guesses anyone can maybe write on the chat? How many companies, just take a wild guess, how many companies or what percentage of companies would be fulfilling all of these criteria? Okay, JP says 100. Anyone else? Anyway, so I'll answer that. So you will be surprised. It varies from anywhere between 25 to 40 companies only. So I'm giving a range because every quarter or every year when the results come in, the number of companies keeps changing. Now that is like less than 1% of the companies, almost 0.5% of the companies which are listed. So Sudarshan says 15%. So that's very high now. Now you know Sudarshan. So out of these 25, 30, 40 companies, if I invest in all of these companies, there are chances that I'll lose money. Now why so? Because every company is in its own industry, and every industry has its own cycle of going up and then going down. Now, as Warren Buffett said, I have to now research thoroughly on these 25, 30, 40 companies, and then further shortlist my final list of 5 to 7 or maybe 10 companies, and then invest in them. So that's why this process of stock investing is rigorous. It is not. It should not be based on tips and hearsay. Now let's take a couple of examples of companies which are fulfilling these criteria. There is this company called Supreme Industries. They're into plastics. They're the biggest plastic manufacturer of India. They have more than 5,500 products as on today, which they are producing and selling in the market. Look at their revenue growth from 674 crore in 2001 went up to 3,300 crore in the last declared results. Look at the net profit from 11 crore to 213 crore. Look at the dividend. Now the last column in the red, it shows the percentage of net profit. So for example, a company gets a net profit of 100 CR. What percentage of that profit is distributed to the shareholders? Now company can choose not to give dividend also. They will say, I will invest this 100 CR in the expansion of the company. And when the company expands, the share price will go up. Now sounds like a very fair point. But the catch in this is whatever amount they will use in that expansion, there can be a possibility of loss as well. It's not guaranteed that the company will go up when they expand. So if I get some amount in dividend and whatever amount is left that is invested and still the company is growing, that's a better company compared to a company who is not giving dividend at all. So look at their dividend amount in the second last column. So net profit was 11 crore in 2001-2. They gave away 6 crore rupees in dividend. They were left with 5. From 5 crore, they were able to make it 14 crore of net profit next year. Then they gave away 7. They were left with 7. They made it 21 crore in next year. So they keep giving dividends and then keep making growing profits. So that's a very strong, fundamentally strong company. Now look at their share price. Now what's the kind of returns their share gave? If this is the kind of net profit and revenues they have. So in 2001 January, the share price was 12 rupees 22 paisa. In 2001 September, it came down to 3.5 rupees. There was this dot-com bubble and also that attack on the WTC, because of which the financial markets came down across the world. 2015, again, if you look at it, it was 746 highest price and lowest price was 570. So you can look at the share price, even though the company has been doing very well in terms of revenue and profit, still the share price is very, very volatile. It is not going up and up all the time. It goes up and down, and then in a zigzag fashion. Now you look at the lower part of the table, it talks about best case scenario and worst case scenario. So worst case scenario is I buy the share in 2001 at the highest price, that is 12 rupees 22 paisa. And I sell it at the lowest price in 2015, 570.5 rupees. In that case also, I get 31.59% CAGR returns. Now, in your FD, you get 7.58% return. This is that 31% return, which is 46 times of your money. In case of the best case scenario, it is 46.68% CAGR, 213 times of your money. And this is apart from the dividends which you have got in last 15 years. That's not calculated in this table. So that will take the returns even higher. Looking at the shareholding pattern, just look at this middle red column, which says FIIs. If you look at the last figure on in this column, it says 0.04%. That was the stake holding of all the FIs across the world in this company in year 2007. Every quarter, the stake increased and it is almost 21% now as on today. So the FIIs across the world, the pension funds and the sovereign wealth funds, have been buying this company in every quarter. So that gives confidence in the company. Coming to the second industries, the name is an illusion, nothing to do with Page as such. So they are into jockey innerwears. They have franchisee of jockey in 4 countries, that is India, Nepal, Sri Lanka, and Dubai. In 2001 and 2 in India, they had a revenue of 37 CR, came up to 1700 crore in last financial year. Net profit from 1.76 crore to 232 CR. If you look at their net profit as dividends, even higher than Supreme Industries, 55, 39, 92, 57, 42, 28, 46% of their net profit has been distributed as dividends. And they have been doing this consistently, just like Supreme. Look at their share price, 2007 they got listed. Again, look at the ups and downs, the volatility in the share price. 2007 December it was 516, March it was 240. 2015 it went up to 16,860 and was down at 10,680. So look at the volatility. Again, worst case scenario 46% returns, best case scenario 70% returns. Apart from dividends, again, dividend calculation has not been added in this. The story with their foreign institutional investors. If you look at this column in the center, 2007, 5.73% stake was held by FIs. Today it is 34%. So again, consistently FIs have been taking stake in the company. One more classic example. There's this big time investor, Mr. Rakesh Jhunjhunwala in India, in Mumbai. He had shares of Titan Industries. Now Titan has two major businesses, watches and jewelry. Tanishq comes under Titan. So in year 2000, if you look at the third column, he had number of shares 804 lakhs, that is 8 crore shares. One share was worth 7.9 rupees. So total value was 63 crore. Again, we just shared the entire world markets were down in 2001. So share price came down to 1.17 crore. So his value came down to 9.4 crore. So in terms of percentage, it came down by 85%. For example, you invest 1 lakh rupees in a particular share. In next year, 1 year, it comes down to 15,000 rupees. So that's the kind of depreciation he saw. But he did not sell any share. Number of shares are constant. From in next 7 years, from 2001 to 2008, the value of 9.4 crore went up to 690 crore. Value of share price went from 1.17 rupees to 85.75 rupees. In 2009, again, we witnessed subprime crisis, global financial crisis. So value came down again by 60%. 100%, 100 rupees became 38.95 rupees. So if you invest, say, 10 lakh rupees, it becomes 4 lakh rupees within 1 year. So that's the kind of depreciation he witnessed. From 2009 to 12, share price became almost 10 times. 2013, there was a huge fluctuation in gold prices. Now, when gold fluctuates, there are losses to Tanishq because they buy gold in bulk quantity. They, for example, buy at higher price, gold prices goes down by the time they sell the jewelry. They have to sell the jewelry at that particular day price of gold. So again, the company had net losses in this year, and the share price again came down from 313 rupees to 200 rupees. Having seen all this volatility, by the end of 31st December 2015, this guy was holding the same number of shares and it was worth 3,554 crores. Now, this is 378 times from the low of 9.4 crore and 60 times from the holding value in year 2000 from 63 crores. So that's the kind of appreciation which he saw by not doing anything, even though there was a lot of volatility in the stock. Now there was interview. He was interviewed in CNBC and asked that in all these three scenarios, the stock of Titan came down by a huge percentage, even worse than the benchmark. It was performing worse than the market. Then why didn't you sell the stock? So he had a very interesting response to that. He said, "Why should I sell a stock when it has not done any mistake? Why should I sell a company when it has not done any mistake?" In 2001, it was global financial crisis. 2009, 8-9, it was global financial crisis. 2013, there was speculation in the commodity called gold. Now, all these three incidents are short term. None of them stay for 2, 3, 4, 5, 6, 7 years to come. They are always 1, 2, 3, maximum 2.5 years. Titan and Tanishq were increasing their number of stores. They were adding more revenue. They were adding net profit. Net margins were increasing. Management was doing good. There was no government law against them. So why should I punish this company? Why should I sell the company? So that shows the conviction and the patience this guy had in the research he has done. So the idea, the message in this slide is, in next 10 to 15 years, you will witness this kind of downturn in stock market at least thrice. Now, if you cannot bear that, you should not invest in stock market. If you can bear that, you can see the results. You can bear the fruits. Now, if you have noticed, one of the criteria was minimum government intervention. Now, all these three companies I've talked about, there is hardly any government intervention. The government cannot dictate the prices of the products because there are other cheaper products available. Government cannot say to Supreme that you should not sell such expensive plastic. They cannot sell to. They cannot ask Jockey to sell for cheap. They cannot say Titan to charge less making charges. So there's no government intervention. So again, coming to the Gyan by the Guru, he says that if you don't feel comfortable owning something for 10 years, then don't own it for 10 minutes. Again, it's an indication towards the day traders and the short-term investors. And the design of the stock market is such that the money is transferred from active to the patient. So if you look at what this guy Rakesh Jhunjhunwala did, he was just sitting passively. He was not doing anything, and he made money. People who were trading day in, day out, or trading every month or every 6 months or every year, they lost money when the market fell, and they panicked and they exited after making loss. So it's important that you have patience when you're investing in stock market. So a lot of investors tell me and share that the reason they are not investing in stock market is, of course, that it is risky. It is volatile, and they cannot see their 100 rupees going down to 80 or 70 or 60. Now, if you look at the concept of risk, it cannot be eliminated. It can only be managed. You can mitigate the risk, cannot eliminate it. And it is unnatural to do that, actually. So if you look at the wild animals, I mean, they are risky. They are dangerous for human beings. But still, those same human beings are spending crores of rupees to save them, to preserve them, right? Which is quite an irony. But that is required to maintain the balance of the nature. It is unnatural to eliminate the risk. So risk cannot be eliminated. It can only be managed. And if you manage it well, you do come out unscattered after a long period of time. It is worth taking the risk in the long run. So again, coming to risk is there when you don't know what you're doing. If you are just trading day in, day out without the knowledge of the company, that is where the risk is. And also diversification is a very debatable topic. Now, what the view of Warren Buffett is, it is required only when investors do not understand what they're doing. So he gives the example of his own portfolio. Berkshire Hathaway holds 4 stocks, and that entire portfolio is worth 65% only in those 4 stocks. So if you have done your research thoroughly, either you do it thoroughly or you give it to someone who is doing it full time. So if you're doing that, then there is no the risk, and you don't need that kind of diversification where you invest in 20, 25, 30, 35 stocks, because that will reduce your returns by a huge margin. Now, having said all this, people still lose money in stock market. If you talk to 100 people around you who have invested money in the past, I believe at least 90 will say that they have not made money, they have made below average returns, or they have lost money. Why so? Even though there are good companies, there is a possibility of making a huge money, and market has been doing good. There are 2 misconceptions. I could not, I have not been able to find a third one. Everything is covered in these 2 misconceptions. So it is considered a quick money making tool. You do not invest in stock market the way you invest in a real estate, in a property. You don't invest in stock market the way you invest in an LIC policy, 20 years, 15 years, 25 years. You don't invest in real stock market the way you invest in PPF, 15-year lock-in. So you don't have patience when it comes to stock market. That's one major reason. The second is the research, which has to be done. It's not a part-time job. Now, what people do is they say that I'm educated, I'm intelligent, I'm successful, I'm capable. I will read a couple of magazines. I'll watch CNBC. I'll take tips from my friends who are working in the stock market, and I will create my own portfolio, and I will make my returns. So it doesn't work in the long run. You'll either end up losing money or making substandard returns. So it is a full-time job, and it has to be a long-term investment. Both the criteria have to be fulfilled, not one. So anyone who has lost money around you, ask them these 2 questions. How long did they invest for? And when they invested in the particular stocks, who recommended them that stocks? And how did they come to the research? How did they come to the conclusion of investing in that? And you will know why they lost the money. Any queries, any questions so far? All right, coming to next topic, personal finance. Now, the most important question which you should ask yourself before you start investing is, what returns should your investment generate? Now, why is it important? Depending on what your expectations are, that's the level of risk you will take in your investment. Now, when I ask these questions, I get again very, a huge range of responses. Some people say 15, some say 20, some say 25, some say 30. I'll give you a context to this, what returns you should expect. Now, this guy, Warren Buffett, has been investing in market for a very long time. He made his entire wealth through this. He has this rags to riches story. He did not inherit any property as such, or any amount of investment as such from his parents or grandparents. This guy has made a return of only 21% on the 90% of his total wealth, which is in share market, and he could manage to become fourth richest or third richest just by making 21%. Now, for some people, 21% looks very low. Now, why is it so? Just look at your family's investment pattern or your own investment pattern. You have a certain amount kept in your home as cash that is generating 0% returns. Say out of 100, you have some amount there. Some amount is lying down in your saving bank. It is giving you 3, 4, 5% returns. Some is lying down in LIC policy or some PPF or fixed deposit is giving you 7, 8% returns post tax. Some amount is in real estate, maybe giving you 15% post tax. That is also on the higher side, I believe, over a long period of time. Entire 100 rupees which is invested today, it is not giving you more than 10 to 12% return. That is also on the higher side. For some, it will be lower than 10%. So if you can manage to make your entire wealth, or maybe a huge chunk or majority of your wealth, 90+% of your wealth, to grow by more than 12%, you are sorted. So anywhere between 12 to 15% returns is good. 15 to 18 is very good, and 18 plus is exceptional. And I'm talking about long term. Long term means 15, 20, 25, 30 years. You should be able to maintain that return. Not for 1 year, 2 year, 3 year, 4 year. That is short term. You might make 30% returns in 2 years. That is no good. You should be able to do it on a sustainable basis. Now let's look at some numbers to understand this concept clearly. Only 5,000 rupees per month. So total investment in 1 year becomes 60,000 rupees. Average career of an individual is 40 years. You start earning at, say, around 25 years of age, and you work till 65, and then you retire. So 60,000 into 40 becomes 24 lakhs. On the top, you can see this figure of 24 lakhs. Now you have different rate of interest mentioned here, and you have number of years on the left hand side in the rows. So we start from 5 years, go up to 40 years. Any investment for less than 5 years is not recommended in any asset class. I'm talking about real estate and equity, the risky asset classes. So you look at the first column, saving bank. If you're investing 5,000 rupees in saving bank and getting 4%, so after 40 years, look at the last value, 0.59. This is in crores. So 24 lakh rupees becomes 59 lakh rupees. In case of fixed deposit, 7% is, I'm taking post-tax returns as 7%. 24 lakhs becomes 1.32 crores. In case of corporate FD, corporate bonds, now this is not risk-free. There is a chance of default in case of corporate FDs, unlike fixed deposits and saving bank. So if you are able to manage to get 9% without any default, you'll end up having 2.36 crores out of 24 lakhs. The next column is in green. It says private lending. So private lending usually happens, or even in case of banks, it happens right around 12% or 13%. So at 12%, 24 lakh becomes almost 6 crores. Now there's another term written there under private lending. It says household inflation. Now very important, please listen carefully. Government inflation is anywhere around 5, 6, 7% right now. But that is not your personal or household inflation. That is government declared inflation. Your inflation also includes your extra expenditure, your lifestyle expenditure. You take example of mobile phones. 10 years back, it used to be a luxury. At least buying an expensive phone used to be a luxury. Today, 20,000, 30, 40,000 rupees phone is a, and every member of the household has it. And every 3-4 years, you change the handset. So that's a lifestyle expense. That is increased. 15 years back, I give you another example. 15 years back, or even 20, 25, 15 years back, almost every individual in the country used to have his first car as Maruti 800. Today, that's not the case. People aspire to buy at least maybe a Swift or maybe a Wagoner or maybe something else. So all these things add up to it. You go for international vacations, you go for domestic vacations, you prefer to stay in a 4-star, not a 3-star. So now all these things add up, and your household inflation is 12%. Your expenditure is increasing every year by 12%. Which means if your investment is generating less than 12%, that is on the left-hand side of the table, 9, 7, and 4%, your wealth, you're going down every year, every day. Majority of the Indian population have been saving their investment. They're making their investments in fixed deposits, LIC, and PPF for around 7, 8, 9%. You look at the last column, you will end up having 1.3 to 2.3 crore, whereas to maintain the same living standard, you should have 6 crores. So these people who are not saving, who are saving in fixed deposit and other such safe investments, so-called safe investments, it is actually very risky, and they end up working till the age of 70, 75 because they are not able to match the inflation. Inflation is expects you to have 6 crores, whereas you have only 1.3 or 2.3 crores. The only two asset classes in India which have given more than 12% is real estate and share market. Share market, I'll talk again in further slides. What's the kind of returns we have generated in general. I've taken a couple of example of couple of companies, but they are exceptional examples. I'll take generic example also. So if you're making 15, 16, 18, or 20%, 20% is very high. You should expect anywhere between 12 to 16%. That is more realistic. So if you're making 15% returns, 24 lakh becomes 15.7 crores. 16% returns becomes 21.88 crore. 18% return, it becomes 42 crore. 85 crore. Now again, the idea of this sheet is the amount of investment is not important. Rather, where you are investing and for how long you're investing, that is more important. Right? Now, having said that, one more thing I would like to, this is my personal opinion. The kind of returns which we have witnessed in real estate in last 15, 20, 25 years, we should not expect that level of returns in next 10, 15, 20, 25 years to come. Now, real estate in India was hugely driven by the black economy, the cash economy, which is drastically reducing now. And with the advent of GST, it will further reduce. And this will have a huge impact on the real estate prices. We already know that the real estate is in a big downturn in the country for last 2.5 years, and there is no, there is no hope of revival in next few months for sure. So that leaves you with equity as the only good option to get more than 12% returns. Now, if you compare equity and real estate, we just saw in the initial table, first few slides, the advantages of equity investment. It is tax-free after 1 year, which is not the case with real estate ever. It is liquid money. You can take out the money at any point of time. You can invest in parts. Now, 5,000 rupees per month cannot be invested in real estate, but it can be invested in equity market, right? You can withdraw in parts, you can invest in parts, right? And it's all clean money. You don't have to manage anything. You don't have to manage the property. You don't have to look after the property. You don't have to look after the shares. It is in the digital and electronic format. So that makes, these are the benefits of investing in stock market. Now, looking at the same table at 20,000 rupees per month, just to give you a perspective, now you end up investing 96 lakh rupees over a period of 40 years if you invest 20,000 rupees per month. So look at the last four columns. 15%, at the rate of 15%, 96 lakh becomes 62 crore. At the rate of 16%, it becomes 87 crore. 18%, it becomes 171 crores. And 20% becomes 340 crore. Now, again, one more point I would like to mention. Now, these figures which you are looking at, 15, 16, 18% multi-crore figures, trust me, they are not big figures. They are not huge. It's not huge money. 40 years down the line, it is not. Now you can do some test in your family. Go and ask your grandparents or your parents that 40 years back in 1975 to 80, what was the monthly expenditure of the family and how many people were staying. We used to have joint family in those in those periods. So how many people used to stay in the house and what was the monthly expenditure? In the same proportion, calculate the monthly expenditure today. Now, when I did it, I found that the family which was spending 1,000 rupees per month in 1975 to 80, they are spending 1 lakh rupees per month today. So that's the huge gap. It's almost 100 times, more than 100 times in some cases. So if it is 100 times in 40 years and it is 1 lakh today, 40 years down the line, 1 lakh multiplied by 100 becomes 1 crore. Now that looks like a huge and a irrational figure to have. You can't imagine spending 1 crore rupees per month. But 40 years back, even your grandparents or parents never imagined spending 1 lakh rupees per month. Right. So that's the magic of compounding. It becomes huge with, in the last, in 30, 35, 40 years. And you don't really get to know. You don't realize that, early in your life. Looking at again, another figure, 50,000 rupees per month. So you end up investing 2.4 crore over a period of 40 years. Last four figures, 2.4 crore becomes 157, 218, 429, and 850 crores. So again, the amount of investment is not huge, but the right asset class and the right returns have created this kind of wealth. It's very common. It's very common in Indian families when a child is born in the family, the grandparents, the dada dadi, nana nani, or even the parents, they will buy an insurance policy for the child, or they'll do an FD. Now you just saw what FD will fetch you. Nothing. It's worth actually nothing. 20 years, 30 years, 40 years down the line, earning returns at 6% and 7% or 8%, and your inflation, your expenditure growing at 12%, you can't expect to have any sort of wealth creation at the end of your career. So in our view, it is not risky to invest in stock market in India. Rather, it is risky if you are not investing in stock market in India. That's the only asset class, or maybe one of the two asset classes, which can save you from the inflation. If you want to fulfill your long-term goals, you cannot miss investing in stock market. And if you're investing for long term, it is not risky, not at all. Interesting example. I'm sure a lot of you will be able to relate to this. Any queries so far? I hope you guys are able to listen clearly and you can view the image clearly. Any queries? Any questions? All right. So look at this figure, Mr. Saxena, Mr. Gupta. Mr. Gupta started investing at the age of 25. Mr. Saxena started 10 years late at the age of 35. Mr. Gupta invested 5,000 rupees per month, whereas Mr. Saxena invested 15,000 rupees per month because he started late. Both invested till the age of 60, till their retirement. And Mr. Gupta ended up investing 21 lakh rupees from his pocket, 5,000 rupees per month for 35 years. Whereas Mr. Saxena ended up investing 45 lakh rupees from his pocket at the rate of 15,000 rupees per month for 25 years. At the rate of 15% returns, look at the final amount. Mr. Saxena ends up getting only 4.13 crore, whereas Mr. Gupta has got 5.7 crore. It looks surprising because the amount of investment was thrice in case of Mr. Saxena. Still, he ended up making only 4.13. Again, so this testifies that amount of investment is not important, but how early you start and how long you invest for is more important. Now, 10 years at the age of 25, usually youngsters do not prefer to invest. Argument you will get is it's time to enjoy, time to have fun. Why should I worry about saving and all that? So it's not about saving huge money. It's about saving the minimum you can. The later you start, the tougher it gets to match up. Now, assuming both of them had a salary of 50,000 rupees, Mr. Gupta was living a lavish life, at least compared to Mr. Saxena, because he was spending 45,000 rupees per month. He was spending only 35,000 rupees per month. Still, after spending so much, Mr. Gupta could make more money at the end of his retirement. So it's very important that you start early. Amount is not important. Now, if you look at the right-hand side column, what Warren Buffett says, you should save left after spending. Rather, first save, and then whatever is left, you spend that money. The second point is, if you buy things which you do not need, soon you will have to sell things which you need. So I'll give you a very recent examples which is happening in our generation these days. Say you find something on an e-commerce website at heavy discount. A t-shirt is worth 1,000 rupees, you're getting for 300 rupees. You have all the reasons to buy. Why? Because 1,000 rupees t-shirt is coming for 300. The idea is not that it is coming for 300. You should buy if you really need it, because you don't realize how much you end up spending by buying these 300, 200, 500, 400 rupees stuff. If you need it maybe 2 years down the line, you buy 2,000 rupees shirt, but you buy only when you need it, because there's no end to spending. Now I'll share one personal experience in this case. I remember I started working in Gurgaon in 2007, and my in-hand package was not not huge. I just graduated and I started working. I got a call from my father just a couple of days before I was supposed to get my first salary check, and he asked me that what have you thought about investing? What's your plan for investments? So I said, yeah, I definitely want to invest. I'll start investing very soon. I'm getting my check. So he said, what's the amount which is there in your mind? How much you want to invest? So I said, I'll let you know in, say, a month or so, because let me see what's the kind of expenditure I have to bear in Gurgaon, and whatever I'm left with, I'll invest that. So his answer to that was, if that is the approach you have, you will not be able to invest for next 7 to 8 years minimum, because you will not realize when you will end up spending the entire money. Instead, first invest whatever the smallest amount you can invest. Even 2,000 rupees is fine. But first invest on the day 1 or day 2 after getting your salary. Then whatever amount you're left with, spend that entire money. Don't leave anything. Don't worry about saving after that. But first save. I started doing that. Within 6 months, 7 months, I had this realization that if I would have got this call from my father after 6, 7 months, I would have not been able to save at all, because I would have got this habit of spending the entire money which I get. So investment is more about habit rather than investing big. So earlier you get this habit, the better it is. Then even an amount of 500 rupees would have been a big thing for me, because I would have got this habit of spending the entire money in my 30 days of time. So it's important that you start early. So there's a very thin line between earning money and creating wealth. Thin line, what I mean by that is, you keep earning more and more in your career, and you keep spending more and more. But whatever little you save and you invest for long term in the right asset class, wealth. Now, the definition by Warren Buffett of investment horizons, the length of investment is, if you're investing for less than 3 years, you are a speculator, you are a trader, you are a gambler, you're not an investor. 3 to 5 years investment, you are a short-term investor. 5 to 15 years, it's a medium-term investment, and 15 years above is a long-term investment. Now, it looks like a very huge, long time, 15 years, but if you look at your own family, your extended family, your friends, your neighbors, and you just observe the property which you are holding for more than 15 years, be it your own house, be it some other land, some ancestral land, be it any office, factory, or any other property. that property or that set of properties will constitute majority of your wealth today, maybe more than 90%, 95, 99% in some cases, right? So wealth creation is possible only in long-term investments. You invest in some property or share market twice in next 2 years, and you sell that property or that asset, you will end up spending that money. You have made very good returns 2 years or double the amount in 3 years or even in 1 year. But if you sell that asset, you will end up spending that money. It will not create wealth for you. Wealth will be created only in long term, and in long term 15% is more than enough. You don't need 30, 40, 50% to create wealth, but it should be sustainable. It should be possible in long term. Now that relief which you have at the back of your mind, that you have this kind of assets backing you in your family or in your household, that is because of those long-term investments, not because of short-term investments. That relief is because of that. So think about it. You look at the, I mean, it's very simple. You look at the compound interest formula. The most powerful input is the number of years. It is an exponent. And we always look at the principal amount. A lot of my friends and my clients and my, my colleagues tell me that if I don't invest a good amount, I would not be, it will not be interesting for me. And the kind of investment horizon they look at is 1 year, 2 years. So the amount is big, but the number of years they want to invest for is not big. So that's where the trouble is. We just saw in the sheet 5,000, 20,000 rupees per month is more than enough, provided you are investing for long term. Look at the example below. Suppose you start investing in the year 2008, investment amount 1 lakh rupees per annum. So 8,300 rupees per month. Expected returns 15%. Value in 2038 becomes 4.35 crore. But if you get late by only 2 years, which is very likely, you end up getting 3.27 crore only, 1 crore rupees less for investing 2 lakh rupees less only. So that's the kind of impact it has when you start late. So it's not about 1 year, 2 years, it's about a very long term. So investment is very boring. If you are looking for entertainment, please take some money and go to a casino. That's where the entertainment is, right? So investment is very boring activity. You buy a piece of land, you go and stand in front of the land. It will not increase faster just because you're standing there. Or you start watching your shares every day on the screen. They will not start running. You focus on your job, you focus on your business, you grow there so that you can grow your investments. And investment will take the returns will take their own course of time. In the own course of time, they will come up. You cannot, I mean, if you want entertainment, it will cost you something. Entertainment will not give you returns. It will cost you something from your pocket. So we're in the last leg of the presentation, another 10 to 15 minutes. So talking about taxes, quite a few ways you can save tax in India. One is home loans. Of course, if you have taken a loan on any property, you can claim tax reduction on interest amount in case of under construction properties. If you're doing that, then it's perfect. You don't need any other tax saving. But if you're not doing that, and you have this tax exemption of 1.5 lakh rupees per annum, the kind of options you have is ELSS, equity linked saving scheme. So there are mutual fund schemes where the money is invested in stock market. So it's as good as called stock market investment, right? You have 5-year bank FD. Now only 5-year bank FD has got tax exemption. If you're doing a 2-year, 1 year, 6 months, 3-year FD, you do not get tax exemption. And in this case of 5-year FD, you cannot even break it in between. If you break it in between, your tax exemption will be gone and you have to pay that tax. PPF, look at the again, look at the characteristics. Lock-in period. So ELSS has the minimum lock-in period of 3 years. 5-year bank FD is 5 years. PPF is 15 years. National Savings Certificate is 5 years. Insurance is 5 years. EPF is Employee Provident Fund. There is no minimum lock-in period. So minimum lock-in period is equity linked savings scheme. Look at the returns. We just saw the returns in stock market. 12 to 15% is very much achievable in long term. Bank FD, you get 8%. In case of PPF, it is 8.1. Certificate, it is 8.1. Insurance, it is 4 to 10%. EPF, it is 8.8%. Now the best part, look at the tax applicable. ELSS, there is no tax because I just shared with you. Now there was a question on tax in stock market. In stock market, any investment for more than 1 year, it is tax free. So you invest, if you are investing 1 lakh rupees in stock market today, and you exit in that investment after 365 days, anytime in your life, in 1 year, after 1 year, 2 year, 5 year, 10 year, 20 years, whatever profit you get, that entire profit is yours. You don't have to pay a single tax to the government, and it is all white income, right? If you're investing for less than 1 year, it is 15% tax, 1.5. Even if you're in the 30% tax bracket, it is 15%. So if you invest 1 lakh, it becomes 1,20,000 in 10 months, and you sell those stocks, you'll pay 15% tax on 20%, 20,000 rupees. That is 3,000 rupees tax will go, 17,000 rupees of net profit. So even in case of equity linked saving schemes, the money is invested in stock market through mutual funds. So again, there's no tax after 1 year, though there's a 3-year lock-in period. So after 3 years, when you withdraw the money, there is no tax. It is tax free. In case of bank FD, it is taxable even in case of 5-year investment. Interest is taxable. Tax exemption is different, and tax on returns is different. PPF, there is no tax. Saving certificates, again tax. Insurance, there is no tax. EPF, again, so if you are withdrawing your provident fund amount after 5 years, there is no tax. If you are withdrawing it before 5 years, say you change your job and you withdraw the amount of the previous employer's provident fund, you will be taxed. But if you have crossed 5 years, then there is no tax. But the returns are again only 8.8%. Any queries on the tax saving part? So the message of this slide is that equity linked saving scheme is the best option when it comes to tax saving. You want to save 1.5 lakh rupees tax every financial year, you can simply invest in equity linked saving schemes and forget about it for 5 years. 3 years is lock-in period. Does not mean you have to withdraw after 3 years. You can stay invested for 5 years and more, which is advisable. So a lot of people have cash lying down in their savings or current account, or they invest in fixed deposit. There's a very good alternative to this, where you earn risk-free, almost very low risk returns, and much higher returns compared to savings bank. That's called liquid funds. They are again mutual fund schemes. So you look at the table. It comes to returns. Saving account gives you 4 to 7% returns. Fixed deposit gives you 7 to 8% returns. Both are taxable. Even in case of liquid funds, it's taxable, but it gives you 8 to 9% returns. Tax as per IT slab in case of saving bank account after 10,000 rupees. So up to 10,000 rupees, it is tax free. Then it is taxable. Fixed deposit is as per IT slab. Liquid funds, it is as per your income tax slab for less than 3 years. And after 3 years of investment, it is 20% tax. That too after indexation. Exit load. Now, exit load means when you withdraw money, is there any penalty? So in case of saving bank account, there is no penalty. You can exit you can take out money from ATM or through check at any point of time without any charges. In case of fixed deposit, if you are breaking your FD, it's almost 1% charges there as a penalty. So if you're earning 7 to 8, you will earn only 6 to 7. Now coming to liquid funds, exit loads are again nil. So you invest in liquid fund today, you can exit tomorrow without any exit load, any charges. Liquidity, saving bank account, anytime you can take out money. Fixed deposit in 1 to 2 days. It takes up to 3 days also sometimes, depending on the bank. Liquid funds, next day you can get the money. You apply for the redemption today, next day you get the money back. Risk, it is nil in savings and fixed deposit. Very low in liquid funds. Now you look at where liquid funds are invested in the line above. They are short-term market instruments such as treasury bills and government securities. So if the government defaults, then there is risk in liquid funds. So it is as safe as fixed deposit and saving bank account. Now, there's one very important thing to note. In case of saving and fixed deposit, though it's technically, it's practically doesn't seem to be possible. But in case a bank goes bankrupt, if the banks shut down, you get only 1 lakh rupees insurance from the government of India. So if you have 30 lakhs, 20 lakhs, 10 lakhs, 5 lakh rupees in your fixed deposit and saving banks put together, bankrupt, forget about the interest. You will just get 1 lakh rupees insurance back from the government of India. Rest of the money is gone. So technically, it is not risky. Practically, yes, it looks very unlikely that any of the banks will go down. But given the NPA news going on in the market, you never know what happens. When Lehman Brothers can go down in 2008, such a huge company, then anything can happen with any company in the world. So any queries on liquid funds? So the idea is you should have 3 to 4 months of your monthly expenditure, 3 to 4 months of expenditure lying down in your saving bank for as a buffer. Anything apart from higher than that is a waste of money. Instead of getting 4%, 6%, you should invest in liquid funds. FD is also not that easy. You will be reluctant to make an FD. You think long term when you do FD. But in case of liquid funds, you can invest the way you can put the money the way you put it in a saving bank account. So it's about optimizing the returns. Now, why I'm saying liquid funds, why I'm not saying stock market here, because this is a money which you might require in short term. You might require this money in 6 months, 3 months, 1 year, and you should not invest for that short period of time in stock market. So this money can at least earn, instead of 4 to 6%, it can earn 8 to 9%. So last topic of the session. So I would like to have some answers from the participants on this. If you want to participate in the economic growth of any country, be it India, be it any other growing economy, China or Russia, Brazil or South Africa, what are the ways in which you can become a part of the economic growth of a country? What are the different ways? Any answers? Any thoughts on this? Okay, JP says startup business. Fine. So business is one of the ways. So if you are doing business in a growing economy, the chances of your business growing is also good. So your economic growth will also happen along with country's economic growth. That's one. But there's one catch in this. When you do a business, you do business in one particular field, and the formalities or the the kind of requirements to start a business and then to close it are not easy in any country, especially developing countries. So in India, if you plan to shut down your private limited company, it's a headache. It's not easy to shut down a private limited company. So though it is one of the ways, but not the only way. Entrepreneurship, yes. So again, startup or traditional business or any sort of business activity you can do. Even land investment, I would say, is one of the ways. Though land is more local investment, as in if you buy a land in particular area, if there is development happening in that local area, then your land price will appreciate. But indirectly, it is also dependent on the economy of the country, in some extent. So one more way is stock market. Any stock market of any country reflects the economic growth of that country. Now, in case of stock market, you don't have to go through those many requirements. You have to just buy whichever industry, whichever company you think is growing in that country, and you can buy multiple companies, multiple industries. You can buy you can do business. So when you're buying stocks, you're actually becoming a partner in the business. You're doing business in that country, in that industry. If I buy Supreme Industry, I'm doing plastic business. If I'm buying Titan Industry, I'm doing jewelry business. Right? If I'm buying, say, Asian Paints, I'm doing paints business. and I can sell the business at any point of time again. So again, it's very easy. I can just press the sell button and I can exit the business. So it cannot get easier than this to start a business and to exit a business. Yeah, just hold on. Right. So looking at the Indian stock market chart from 1980, when the Sensex started, till 2015 end, in 35 years, 36 years, the returns have been phenomenal. Almost 18% CAGR returns. 18%. Now, Sensex comprises of the top 30 companies of the country, which means they are the saturated companies. So I talked about real estate, which is in the posh area of your city. The growth rate of that real estate is not much. So these are those 30 companies of the country where the growth is not much, and still they end up making 18%. So that's the kind of growth which has been witnessed in the stock market. And this is tax-free return. Liquid money, sell any point of time, dividend is tax-free, capital gain is tax-free. Having said that, this is what we have been talking about, the past returns of the stocks, the past returns of the economy. What will happen in future fundamentally, which will take the stock market ahead? Now, I shared with you at the beginning of the session, only 2% Indians invest in stock market compared to 50 to 60% in the US. And the stock market investment amount in India is only 9% of GDP compared to 100% of GDP in US and 30 to 40% of GDP in the developing economies. So there's a huge gap, and this gap will reduce. Why? Because a new generation from land and gold investment, the second point. Very few people, especially those working in the corporates, they don't really want to get into that hassle of buying a agricultural land or a plot, because there's a lot of care to be taken, and they really don't have time for all that. Same is with gold. If you ask a girl today who got married like 2 year, 3 year, 4 year, 5 year back, she is not interested to buy gold jewelry anymore the way her mother or her grandmother used to. So the affinity which Indians had towards land and gold is reducing with generations, right? And these two assets classes attracted the biggest amount of investment. So when the investment is not going towards this side, it will, a part of it, a good chunk of it will go towards the stock market. The people working in the corporate area corporates and other businesses, they will have this kind of awareness, and they will prefer to invest in stock market, at least some chunk of their investments. Now, India's GDP will grow exponentially for years to come. We believe it does not make a huge impact which political party is in power, because if we have come to a era in the country where if the party, if the government is not performing in terms of development, the next time the chances of their coming back to power is very low. So no matter which minister or which politician comes as the president or as the prime minister of India, I believe in the long run the economy will grow, and that's favorable for the for the stock market. You all might be aware of Jan Dhan Yojana, which was started a couple of years back. We already have 24 crore plus accounts through that financial inclusion plan which the government had, which is huge, because 24 crore accounts means more than 60 crore people have come under the financial inclusion. So a family of say 5 or 6 people have opened 2 accounts. So behind every 3 people or every 2 per person, there is one bank account. So these people never had access to the financial services, never had access to the medical plans, to the subsidies, to the insurance plans. So they are not getting into the habit of investments. So it's a huge shift, and this will make a huge impact on the economy in the next 10 years to come. Electricity is still not available in 69% of the households in villages. Now, if you don't have electricity, you don't have fan, you don't have cooler, you don't have AC, you don't have mobile phone, you don't have any electronic gadget, any electronic equipment. So we are already a consumption-driven country. Given the target of the government to get electricity in all the villages by 2019, you can imagine the kind of consumption we are witnessing, right? Next, we are one of the youngest countries in the world. 54% of the population is below the age of 30 years, which again will contribute towards the economic growth. Again, it is favorable for the stock market. EPFO, Provident Funds, minimum 5% of the funds will be invested in the equity market. This was the decision of the government last year. Now, it's a huge mindset shift of the government. The government says the entire world is investing in Indian stock market. Why should we stay away? So that's a huge mindset shift, and it will bring about that this fund, the Provident Funds is worth lakhs and crores of rupees. So the kind of money which will flow to the stock market is huge. So lastly, this is what Warren Buffett said for the US economy. So you look at the developed economies, when they were in their developing phase, look at the returns which they witnessed. So as far as India is growing, the stock market will grow. For the US, this is what he said: over the long term, the stock market news will be good. In the 20th century, United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression of 1929, a dozen or so recessions and financial panics, oil shocks, a fly epidemic, and a designation of a disgraced president. So politics has come in, diseases have come in, oil shocks have come in, financial panics have come in, world wars have happened. The Sensex of United States rose from 66 to 11,500. So as far as the economy is growing, the market will grow. Things which happen in terms of financial panics, they're all temporary. So the news comes that China is slowing down, the Indian stock market goes down. The news comes Greece has defaulted on the loans, the stock market comes down. The news comes that RBI is not decreasing the interest rate. Again, the stock market falls. So these are all very short-term impacts. It will not have an impact in the long run because the economy is growing. So don't get panicked by these short-term. The market went down by 20% last year. That was a good time to invest. So if something is available for 100 and it gets suddenly starts selling for 80, you should buy it. If you have done your research and if you know that in the long run it will go up, it is time to buy more instead of going in the panic mode. Bottom line, we end here. So compound interest is the 8th wonder of the world. He who understands it earns it. He who does not pays it. Crux of this session. If you understand the power of compound interest, you will take the informed decision in your investments. Key takeaways: financial planning. First 2 steps are term and medical insurance. No other policy required. Gold is one of the worst investments. Starting early is more important than starting big. Your total assets must grow at 12% per annum to beat inflation. Equity linked savings scheme is the best tax saving instrument. Choose liquid funds over savings in current accounts and fixed deposits. And last but not the least, investing in stock market is not a choice but a necessity. So we come to the end of the session. Thank you for your time. Number, you can note it down. We do share broadcast messages with our clients, with our investors on the Indian economy, stock market, and other generic topics as well. So if you want to be added in that broadcast list, please add this number in your mobile and please add +91. Otherwise, the broadcast does not reach you. And just drop a message on this that you want to be added with your name and your email ID, and we will add you to that broadcast list. Having said that, any queries now, if you guys have? Any questions on any topic? All right. So it was. Thank you for your patience and listening, going through the entire session. You have my number here, so you can save this number. You can give me a call. You can text me. You can write me an email, and if you have any sort of queries regarding any of your investments or anything you want to do, you can always get in touch with me. Thank you, everyone.